Welcome to Sophie Daddy's channel. Most of the time in trading, we're trying to figure out if a stock is going up or down. But what if you have a strong feeling that a stock is going to do, well, absolutely nothing? Today, we are diving deep into two really powerful options strategies that are built to profit from exactly that, a market that's just stuck in the mud. We're talking about the short straddle and the short strangle.
All right, so here's the game plan. First, we'll get into the core concept of trading volatility itself. Then we'll look at the two engines that actually make you money. After that, we'll compare the straddle and the strangle head-to-head. And then, this is the super important part, we'll confront the massive risk involved and finish up with how the pros actually manage to trade these things without blowing up. Okay, first things first, we need a little mindset shift here. We have to stop thinking about where a stock is going to go and start thinking about how much it's going to move. Or, in our case, how much it's not going to move. We're trading volatility, not direction. I mean, that's the real question, isn't it? If the price is just chopping around, not making any real progress, how on earth can you make money? Well, the secret isn't in the stock's price, it's in the price of the options on that stock. The magic ingredient here is a market quirk called the Volatility Risk Premium, or VRP. To put it simply, the market consistently overprices the chances of a big move. It's like it's always expecting a hurricane, but most of the time we just get a little rain. That gap between the expected chaos and the actual calm is where option sellers live and profit. So when you sell a straddle or a strangle, you're not really a speculator in the traditional sense. You're actually stepping into the role of an insurance company. You're collecting cash, a premium, from people who are terrified of a big market swing. And you get to keep that cash if things stay, well, boring. So how does the profit actually hit your account? Well, it boils down to two key forces that are constantly working in your favor when the market is stable. I like to call them our profit engines. And here they are, Theta and Vega. Think of Theta, or time decay, as this amazing, reliable employee who shows up to work every single day, including weekends, to put a tiny bit of money in your pocket. As time ticks by, options lose value. And as a seller, that's pure profit. Then you've got Vega. This is your profit from calm engine. When market fear or implied volatility goes down, your position makes money. This is super powerful right after something like an earnings announcement. They call it an IV crush, when all that built-up anxiety just vanishes from the market.
Okay, let's get into the actual blueprints for these trades. A straddle and a strangle are very similar, but they offer a really important choice, a trade-off between how much money you can collect and what your odds of winning actually are. So the structure is what makes them different. With a short straddle, you're selling a call and a put at the exact same price, right where the stock is trading. It's like walking a high wire. The payout is great if you're right, but you have very little room for error. A short strangle, on the other hand, gives you a lot more breathing room. You sell a call above the stock price and a put below it. This creates a big, wide profit zone in between. It's less of a high wire and more of a sturdy bridge.
And this table just lays that trade-off out perfectly. Look at the straddle. You collect a much bigger premium, which is awesome, but your probability of profit is lower and your break-evens are tighter. Now look at the strangle. You collect less cash up front, but you get that nice, wide profit range, which gives you a much higher chance of success. So it's a classic dilemma. Do you want a lower probability trade with a bigger payout or a higher probability trade with a smaller one? And now we've arrived at the most critical part of this whole explainer. Seriously. Collecting that premium feels fantastic. It's like free money. But there is a huge, dangerous catch hiding under the surface, and you have to respect it.
You just can't get that sweet, sweet benefit of time decay working for you every day without accepting a very dangerous trade-off. There is no such thing as a free lunch in the markets. For option sellers, the price you pay for that daily income is a nasty little thing called negative gamma. So what is negative gamma? Oh boy. Think of it as the accelerator pedal for your risk. When you're short options, as the stock moves against you, your losses don't just add up one by one, they start to accelerate. A small move away from your price is fine, you can handle it, but a big, fast move causes your losses to just snowball, getting bigger and bigger, faster and faster. And that leads us to this terrifying reality. Because a stock's price can, theoretically, go up forever, the potential loss in these strategies is unlimited. This is not a drill. It's not just some textbook theory. This is the very real risk that has wiped people out. It's the price you pay for selling time.
So if the risk is literally infinite, how in the world do professionals use these strategies? Well, the secret is they don't try to predict anything. They don't have a crystal ball. Instead, they focus entirely on managing risk with a set of ironclad, non-negotiable rules. This right here is their survival guide. Rule 1. Position sizing is everything. Keeping each trade tiny means no single bad trade can ever knock you out of the game. Rule 2. Don't get greedy. They get out early, taking profits at 25 or 50% of the max, long before that scary gamma risk kicks in near expiration. And finally, they use hard data, probabilities like the 16 delta, to pick their spots, not just gut feelings. And this famous quote just says it all. Even when you have the stats on your side, the market can do crazy things. Straddles and Strangles are incredibly powerful, for sure, but they are unforgiving. So the question isn't whether the strategy works. It does. The real question is, do you have the discipline to manage it? What will you explore next?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.